come under challenge. And it is not only the profits which can come under the challenge, my entire registration can get liable to be cancelled. And why this is so is because of an amendment, I think, which was brought in last year. And the amendment basically listed down various parameters on how and when the registration can be cancelled, which is something which we have discussed in the next case study. Yes, so this is the amendment which I am talking about, section 12AB, subsection 4. And if we read this amendment, so this is one of the conditions or one of the criteria which the revenue can use to cancel your registration. And what is the criteria? And if we read, it says that if the institution has profits and gains of business, which is not incidental to the attainment of its objectives, or separate books of accounts are not maintained by such institution in the respect of business which is incidental. So in this fact pattern, given that sale of furniture is incidental to my charitable activity, assuming I don't maintain separate books of accounts for such activity, 12AB subsection 4 tells me that this is a condition, and if the department invokes this condition, my registration is liable to be cancelled. And the game doesn't stop here. What happens? So what are the consequences once your registration get cancelled? And many of us may be aware that there is a new section 115 TD which was brought about a couple of years back, which said that if your registration is cancelled, then whatever is the fair market value of the assets of the trust, of the net assets rather, assets minus liabilities, whatever is the FMV of your net assets, on that FMV, the revenue can impose a tax at MMR, which can be as high as 30-35%. So let's say in this case, let's say if it's a building, it will have land, building, hospitals, whatever. So the fair market value, I'm sure, will run into thousands of crores of rupees. So even for a small, procedural lapse or whatever I may say, that if my books of accounts are not maintained, and that gives a handle to the tax office to cancel my registration, then the consequences are very, very severe. And this is something which all of us need to be mindful of. We need to be mindful of whether the activities which I am doing as a trust, whether it is per se charitable activities, is there any element of business, whether that business can be regarded as incidental or non-incidental, and if it is incidental, whether I am maintaining separate books of accounts or not. I think all those questions, will assume paramount significance given the way the decisions are coming, given the way the Supreme Court is interpreting the law. And I think it will assume far more significance in the days to come.
Saurabh, let me give you a hypothetical situation. So there's a charitable institution which is building skill, helping build skills, and for the underprivileged or the handicapped. Let me put it, the handicapped in some manner, and in that course, that product is getting created, and then you are putting, and then you are generating revenue. I mean, how will you call it? Will you call it incidental? And even if you call it incidental, how will you create a separate books of accounts? Because in the course of teaching the unskilled or the handicapped, or we know, you would have seen in Diwali and all of this, from many charitable institutions, they are making chocolates, and so it's about skilling the handicapped also, and the product as a consequence of that skilling and is being sold in the market. How do you create a segment out of it?
Clearly, I think this is the difficulty, and this is where unfortunately the Supreme Court has said that because all throughout we have been assuming that this is something which is incidental. My predominant objective is charitable, so I need not worry about it. And that is where the Supreme Court decision cuts through the roof to say that it is a business activity. You are selling your products at market rate or maybe at more than market rate also. And if such is the fact pattern, then we will not give cognizance to the fact that 95% of your activity could be charitable, and this is just a minuscule 5% part. So the Supreme Court is very clear, to say that this is a business activity, and once it is a business activity, you need to maintain separate books of accounts, and that is the fallout. And the way we have dissected the law, and even such a procedural lapse of not maintaining a books of accounts can lead to cancellation of my registration, and and the harsh consequences under 115 TD. But I think, unfortunately, this is how the way the law is right
As we
now.
speak, there's a question. What happens
Yeah.
if, I know there's a separate Q&A session, we're reaching that
Sure.
time. So the question is, what happens if the underprivileged wages are offset by the sale of the furniture and the profits pay their wages?
No, exactly. So I think this is where the whole discussion earlier was that if there are profits and those profits are used to pay their wages or their profits are deployed in my charitable activity, there was no issue as such.
No issue. But now,
But now all that fundamental principle just goes away, which is the unfortunate part of this ruling.
So redeployment back into the object of the trust saved us of a lot of troubles. But somewhere the court has distinguished commerce, trade, business as a separate thing and redeployment as a separate thing. So the linkage which was there, which was helping me save this whole issue, letting me get through, that thing has been distinguished now. So I have to independently show whether it's a trade, commerce, business, it's a business activity. If it is incidental, then a separate segment has to be created. So all that hardship is now getting created.
Yes, that's right.
Saurabh, is there any other case study? Or
yeah, there is just one last case study which we can discuss.
Please.
Okay, yeah. So while we were on this incidental business, and this case study is just to bring home the point as to, when can something be regarded as incidental and when can something not be regarded as incidental. So let's say I am a full-fledged hospital and as many of us know that a hospital also has an in-house pharmacy. And that in-house pharmacy can cater to my inpatients as well as to general public. So even I can step in the hospital and buy some medicines and walk out. And let's say those in-house pharmacy is generating substantial profits. So the question really is that whether profits in incidental business are permissible. I think the answer is yes, because as we saw that unlike a GPU, where there is a restriction that your business revenues cannot exceed 20%, there is no such restriction in your per se categories, and hospital will form part of your medical relief category, and there is a no 80-20 ratio mentioned over there. So one view of the matter is that, as far as your core activities are concerned, you cannot do profiteering. But the way the law is, as far as your incidental business activity is concerned, there is no embargo or prohibition. I can very well have, significant profits in my incidental business. Of course, subject to test of morality and the Supreme Court even, coming down on it. But currently the way the law is, the profits in incidental business are permissible. But the bigger question over here would be that when can something be regarded as incidental? Because somebody might very well say that the pharmacy is nothing but a very integral or a core part of your activity of running a hospital. So it can never be regarded as incidental. And this is just pharmacy. You can have a pathology lab or a radiology department or whatever. So can you say that those categories or those functions which a hospital does, is it incidental to the main object of providing medical relief, or it is so integral or so core to the overall or the primary activity that it can never be regarded as incidental? So of course there is no right or wrong answer. In my opinion, I think we need to get into the facts to see that whether something can be regarded as incidental or it is something which is getting subsumed in the primary activity. I think that is something which one needs to take care of. And lastly, and of course, I think we'll just take 2 minutes before we go to Q&A. One important observation in the Supreme Court decision was that the CBDT circulars, what is the binding nature of the circulars? And we all know that the CBDT circulars are binding on the revenue and they are not binding on the taxpayers or courts. But the Supreme Court in this case has made very interesting observations to say that the circulars are also not binding on the tax department if they are not in accordance with the law. And all throughout, based on various decisions, Navneet Lal Jhaveri, UCO Bank, etc., we have always been taking a position that once a CBDT or the board comes out with a circular, howsoever absurd that circular, maybe that circular is binding on the revenue. But I think now the Supreme Court is making a departure from that position that no, if somebody finds out, if the department is able to prove that the circular is not in accordance with the law, then it is not even binding on the department. So the whole shelter of the CBDT circular which taxpayers used to enjoy, whether that shelter is being taken away or not. I think that is something which time will tell. But this is some important facet which is coming out from the ruling.
Sorry, it's not only out here. If this principle applied, then you would appreciate there's so many other issues which will start opening up actually, where this plea has been taken.
Correct. And
just one thing, sorry, before we move into the way forward, I would request that if you could put your questions in the Q&A box. We've already seen one question. One was answered in the discussion and one more we have received. In the meantime, if you can put your question in the question answer box, which is at the center of the screen, bottom center, then we could answer this after the discussion. Please, sorry.
Sure.
Way forward.
Sure. I think as far as way forward is concerned, based on whatever we discussed, I think all of us will appreciate that, these decisions have caused an disruption. So what exactly can be done going forward? One, of course, for 1023C, and given the interpretation of solely, if you are a taxpayer who is registered under 1023C, then the first and foremost thing one should do is to change the object clause so that you fit into the parameters which are described by the Supreme Court. If you are earning profits which can be supernormal, exorbitant, or whatever, now whether those profits are synced with the jurisprudence, like how we discussed, whether it represents a recoupment of losses or you are earning surplus because you have a capex lined up, I think all those questions will be of far more significance. And of course, like we discussed on what is a main activity, what is an incidental activity, what is the profits which are permissible in both the activities, whether you are maintaining separate books of accounts or not. I think all those, sanity checks, health checks, or whatever we may call, I think that is something which will be extremely important, and more so for the reason that if you are not complying with any of these things, the consequences are very harsh. Because once my registration gets cancelled, and if the revenue are to apply 115TD, I think that we are staring at a very, very big tax liability. And lastly, as Aditya mentioned, that if such is the contours, and given that so many conditions, restrictions, is there a way or migration possible for a for-profit entity? Because why do I stick my neck out and take a particular position if let's say I'm to achieve certainty or peace of mind? Let's say if I'm able to carry out the same activities in a profitable organization, and that is something a call any management would have to take. So Aditya, you have anything to add?
No, I think so. I see I have many things to add, but I'm happy there are some questions and we are running out of time. It's already 3:30. So I'll straight away go to the question. There's a question that if a non-GPU trust is incurring losses year on year from sale of products made by handicapped people, then can we say it is not running business, not profit intention, hence not required to maintain books of accounts?
No, I would say it will still be required to maintain books of accounts, because the fact remains that you are selling products, you are doing a business activity. Now, just that the business activity is running into a loss may not, absolve you from the requirement of maintaining books of accounts. I think if such is the fact pattern.
Many times it happens. What the handicapped people would have prepared, you would undersell it. Just, it's like more for creating awareness also. And then through this awareness, donations come. So the objective is not, you just put up a display center and you sell it. Just because I made the sale, and that's why there's another question. I don't know how to answer this. Is that separate books of accounts have not been defined under the Act. Any cue how trust should maintain separate books of accounts?
I think there is a CBDT circular which had come out recently in the year 2022, and I think we can share with them. I think what the circular, I think they enlisted what are the books of accounts which a charitable institution should maintain, whether it's a cash book or a bank book or a receipt and expenditure account. I think there is a circular to this effect which has recently been issued by the board, which actually prescribes the documentation which one needs to maintain.
Sort of one question, whether the bus fee collected for school bus service for own students is incidental activity. Answer is yes.
Yes, answer is yes. I think their Supreme Court has also, given some examples to say that if a school is selling textbook or providing hostel facilities for its own students, then that is something which is incidental. And I'm sure even a school bus service for own students should form part of that.
Will institutions claiming exemption under Section 11 have to revisit their pricing? Example, hostel fees charged from students to cost plus nominal markup as per the Supreme Court decision? Well, if you're actually having obnoxious profits, you definitely need to revisit that.
Agreed.
Okay. And then there's a question. I don't know. This is not. Okay, what is the role of 85% of income should be spent in a year as per the income tax provision after these rulings? Nothing changes, I think. So sorry, we can.
Yeah. Nothing changes. I think the fact that 15% accumulation is allowed and 85% you have to spend, I think that will still remain because that is one of the conditions to claim exemption under A11. But here, the bigger aspect is whether the 100 which you are earning, out of which there is a bifurcation of 15 and 85, whether that 100 is appropriate or not, I think that is the larger question which the Supreme Court has dealt with.
Can an educational institution claiming exemption under 1023C, clause 6, enter into an agreement with associates or third parties to give vacant land of area of school premises on rent?
As we discussed, I think given the interpretation of solely, I think you may not be able to claim an exemption if you are giving something on rent to whatever third parties or associates or whatever.
It's not a constructed car parking space. It's just that I have in a portion which is vacant, no use for me, and someone think can I use that? Whether it's a third party, that rental you cannot give it on. But not about constructing a car parking and doing sales, but it's simple rental income.
Correct. So if you are under Section 11, then perhaps possibly it should not be an issue. But under 1023C, I think after new novel, it can be a challenge. Yes.
There are more questions coming. I don't know, but let me see.
Right.
Any views of differentiation drawn by Supreme Court between business held under trust?
All right. So Supreme Court had devoted a couple of paragraphs on 11.4 and 11.4a, and one glimpse of the Supreme Court decision seems to perhaps take a view that if there is a business which has been carried out by the trust and given that 11.4 permits a trust to do a business, then that should not be an issue. And 11.4 should actually override 11.4a. But still, the common thread which was running that that business etc. is possible under 11.4, provided because the Supreme Court has caveated to say that it should be based on a nominal markup or a marginal profits. But again, we are back to square one to say that even if there is a permission given under 11.4, if there are exorbitant profits, then that could still be an issue.
Yeah. Done. I think we'll close it because we need to start the session. We'll take a break of 4-5 minutes. I request the audience, all can go for a body break. We'll just hold, and everyone can hold on for 3 to 4 minutes, and we'll start with the next session on partnership. Thank you, Saurabh. It was a delight.
Sure.
Please stay on for the session on partnership.
Yes. Thanks everyone.
Recording stopped. Recording in progress.
Welcome back. Now we'll start with part 2 of our session, which is regarding the Supreme Court decision in case of Mansukh, and which is regarding partnership firms. Even though there has been an amendment in 2020, so there's a new law, there's a new code on this particular dissolution, either the tax impact when there's a dissolution or retirement of a partner. But you do get to know that what has been the psyche around the change which happened in 1987, because all cases between 1987 and 2020, they'll all get affected by this. And I can tell you, knowing the way it has happened in India, I'm sure the way it happens in India, this has definitely happened in rampant. That dissolution, this kind of a position was taken for admission or retirement, this kind of a position was taken. So this is very important for those partnership firms who have done some sort of a reconstitution between the periods 87 to 2020. Now, partnership firm, as we all know, is the most commonly adopted mode to carry on business in India for a medium-sized enterprise. The level of compliances, regulatory norms, and costs for maintaining a partnership firm or even an LLP is relatively cheaper with a company structure. Now, having said that, from a tax perspective, partnership firm and LLP are taxed with a basic tax rate being 30, surcharge cess added, and anything which is after that, that is payment of profit, post-tax profit, all of that is exempt in the hands of the partners. This seems quite a simplistic tax regime. Partnership firms, but I'm laughing because I know these partnership firms have their own share of tax challenges, especially when it comes to admission, retirement, or dissolution. And the kind of questions I have heard in the last decade, what will happen, and everyone has a different view. It could be this, it could be this. Someone is confident of a particular view. So I think there's more ambiguity which is there than in any other part of the Income Tax Act. We just finished discussing how the law with respect to charitable organizations taxability has evolved, and still a lot of issues remain unresolved. But believe me, partnership firms have their own share of roller coaster ride in terms of taxability on retirement and dissolution. This is quite a vexed issue. Today we would discuss this. But interestingly, the amendment has put in a complicated mechanism, but probably brought clarity and clarity what has to be done from 2020 onwards. But till 2020, this 87 to 2020 period is a phase where there is utter confusion. Today, we would discuss the Supreme Court judgment on this very aspect, which has raised more questions and concerns than settling the controversy around this topic. For this, I need to go back to the period before 1987. Going back to 1987 period, prior period to 87, partnership firms and its partners were treated as the same. And any distribution of capital assets or dissolution of a firm to its partners was specifically not considered as a transfer under Section 47, subsection 2. Similarly, any distribution of capital asset by a firm to its partners on retirement was not chargeable to tax under the judge-made laws because there was no written laws. Even under the judge-made laws, it was not there. The courts considered that the amount paid to the retiring partner was only towards his or her share in the net assets of the partnership firm, and there was no element of transfer of partnership interest in the partnership assets by the retiring partner to the continuing partners. The partner was not liable to tax as what he or she received or something which is always belonging to him or her in form of his or her share in the firm's assets. As this resulted in a kind of tax abuse where assets were transferred among individuals, routing the same through partnership firm. And we would have heard umpteen cases. This would have happened in the prior 87 period. And using the admission or retirement mechanism to escape taxation. When A party was transferring asset to B party. So he introduces B as a partner and then A retires and B continues as a partner. The asset is transferred and on distribution, there's no tax. So all of that used to happen prior to 87. Government got a wind of it. In order to plug this loophole, the legislature deleted the exemption which was provided under Section 47, Clause 2 and introduced two new sections in the statute. One was 45.3 and 45.4. 45.3 provided for taxability when assets are introduced into the partnership firm on admission, and 45.4 provided for taxability on distribution of assets upon dissolution or otherwise. Although the draftsman with a view to curb the tax avoidance mechanism inserted these sections, but the ambiguity upon the applicability of the Section 45.4 on reconstitution of partnership firm remained a matter of debate before this landmark ruling was passed. In this Supreme Court ruling, in case of Mansukh dying, you can move to the next slide, I think so. Yeah. Although my colleague Basant will discuss the whole ruling in very much detail, but just to talk about the ruling with not even a slide, it would have been very difficult to me. So I just put up a single slide. Although it's actually a tale of more than 10 partners. Partners were there, some retired, some came in, some then again retired. So it's a inflow and outflow of partners which has happened. So each step will be explained in detail, who came in, when, and what happened. But I'll give you a broad contour of this ruling. So in this Supreme Court ruling, it was held that the revaluation of capital asset of partnership firm by corresponding credit to the capital account of the partner would be taxable as capital gains. Now, as you can see from the slide, the case involved retirement of few partners, subsequent admission of few partners, followed by revaluation of assets, and finally credit to the partner's capital account towards the revalued amounts. The said revalued amounts were in fact withdrawn by two old partners. Withdrawn by two old partners. The Supreme Court want to put an end to certain mischief. Rather, the Parliament first wanted to put an end to it, and Supreme Court has actually supported that. But here, I don't know whether it was to put a check to mischief or whether it went overboard. But let's go through the ruling. The Honorable Judge ruled upon substantial question of law, which dealt with the interpretation of the term "or otherwise" in old Section 45.4, which was inserted by Finance Act 1987. The Supreme Court held that credit of revaluation gain to partners' capital accounts can be said to be in effect distribution of assets valued at fair market value. Reason being, as some of the partners admitted with small amounts of capital immediately had huge amounts of capital post-revaluation, which was available for withdrawal. The Supreme Court held that the revaluation involved credit to partners' capital account could be regarded as transfer for the purpose of or otherwise under section 45 subsection 4. The view taken by the earlier, so this view was actually taken by the High Court in one of the cases. It was in the case of A.N. Naik in relation to the interpretation of the term or otherwise to be read as the same kind with the term transfer of capital assets by way of distribution of capital assets and not with the term dissolution. And this was finally upheld by the Supreme Court. As per the Supreme Court, this ruling is aligned with the intent of the legislature behind insertion of section 45 subsection 4 and simultaneously withdrawal of 47 clause 2, which was done by Finance Act 1987. And this was all done to stop the leakage happening due to misuse of the partnership firms as a vehicle to avoid capital gains tax. The decision is relevant to all open litigations related to the time period AY 1988-89 to AY 21-22, as this version of 45.4 on which the decision of Supreme Court is being discussed has undergone the change from 1st April 2020. Now, this was about the Supreme Court. So, the story is not complete if I don't discuss what is after 2020. Now, under the latest regime, we have two sections, a modified section 45 subsection 4 and a new section 9b. Both these sections apply in different scenarios and also have interplay amongst themselves, which my colleague Basant would also be deliberating. So we just did not restrict ourselves to the Supreme Court ruling. What after that? What happens today? So we took liberty to discuss the amended law a little bit also. But however, as the law stands today, while it is a bit complex in terms of understanding the mechanism of interplay between 45.4, the revised 45.4 and the new section 9b, but it's somewhere properly addresses the issues which have been long open, or there was a confusion around it. Complexity in mechanism, but clarity in the outcome. Let me put it this way. Now with this, I would like to invite my colleague Basant, if he could take all of us through the ruling in detail and couple of case studies and also discuss the amended law. Over to you, Basant, please.
Thank you, Aditya, for these opening comments and remarks on this era of partnership, which we have seen for more than last 2 decades. So, as Aditya rightly pointed out, there was an era prior to 1987, and then there was this period from 1987 till 2020, and now, as we see today, we have the new legislation post 2020 onwards. So, this decision which we are going to discuss is pertaining to the period which was post 1987 and prior to 2020. Now, earlier, when we go back, when we take a step back, prior to 1987, the partners and the partnership firm were considered as one and the same. And this was actually used by many as a tool to avoid taxation. It was quite easy for anyone to put in assets in a partnership firm and pass over that asset through retirement by inducting a new partner. So partnership firm became a tool for kind of a tax avoidance, and that is where from Finance Act 1987 the law was amended, and the exemption granting section which existed prior to 1987, the legislature deleted that exemption section, if I may use that word exemption section for simplicity, section 47 clause 2, which earlier granted non-taxability to anyone who could take out the assets from the partnership firm on dissolution. That law got amended. At the same time, simultaneously by the same Finance Act, what happened is that 2 new sections were introduced. One was 45 subsection 3 and the other one 45 subsection 4. As the loophole was with respect to both the aspects in terms of introducing an asset to the partnership firm and also withdrawing the assets from the partnership firm, the first section 45.3 resorted to cases where assets were introduced by the partners into the firm, and the second section 45.4, which is the case which we will be discussing today and the Supreme Court ruling. This dealt with cases where partners used to take the assets from the partnership firm upon dissolution, which till 1987 was not taxable. So with this amendment, which was there from Finance Act 1987, that the whole gamut of taxability of partnership underwent a sea change, and there was no specific exemption available. After this amendment, there had been a lot of decisions from the High Court, and in fact from the Supreme Court also, which had held on various fact patterns as to what is the taxability in a particular scenario. One of the key decisions which was there, which also finds place in our discussion in the Supreme Court matter, is the A.N. Naik decision of the Bombay High Court. I'll just spend one minute discussing this Bombay High Court decision of A.N. Naik. This was a case where the partnership firm was constituted by family members, which was quite a big family, and due to the family settlement, they decided to segregate the assets. And as a consequence, some of the partners retired from the firm and some of the partners were admitted in that partnership firm. And in that process, what happened? The assets of the firm were also distributed to some of the partners within reconstitution, within the retirement phase itself. And there was no dissolution as such of the partnership firm at that point of time. In that context, what the Bombay High Court held is that effectively there is a movement of assets from the partnership firm to the respective partners who are taking away the assets, and the continuing partners are compromising the assets in the partnership firm in favor of the partners who are leaving the firm. In that context, the Bombay High Court held that although there was no dissolution in this case, but it was covered under section 45(4) because essentially there was a movement of assets from the firm to the partners, and the retirement also happened. With this background, there has been other decisions also by the judiciary where typical cases in terms of how the taxability would work, in where only cash was taken away by the partner, or in fact there was no revaluation as such, but there was balances or any assets were distributed. So each and every fact pattern, there has been quite a lot of controversy as to what is the correct position of the law in terms of taxability of reconstitution of partnership whenever there are distribution of the assets by the firm. Now, moving to this decision which we are supposed to discuss today is the decision of Supreme Court in the case of Mansukh Dyeing and Printing Mills. This decision, I'll take you to the facts because the facts are hold a very key in terms of what the outcome of the Supreme Court was in this decision. Initially, this partnership firm, Mansukh Dyeing, consisted of 4 partners. These 4 partners were all brothers, and the partnership firm was engaged in the business of dyeing, printing, and printing of and trading of clothing related items. What happened in the tax year 1991, there were admission of 3 partners in the firm, and effectively one of the old partners, his share of profit was compromised in favor of the incoming 3 partners, so to say. So if you see from the diagram, we'll have partners on the left side. The 3 partners continue for brevity and for our discussion purposes. I have kept them as M, N, and O, who are the old partners who continue with the firm, and P also. And there are 3 partners which got admitted, Q, R, and S. Once this admission happened, the only change what was there is that one of the partners' share got reduced, and the admitted 3 partners got the share which was compromised by the old partner. Secondly, what happened after this? Immediately there was a retirement of 3 partners after that admission, which effectively meant that Mr. M, O, and P in our slide, if you may see, they retired from the firm, and Mr. N continued with the partnership firm with the 3 new post this retirement. So once this retirement also happened, it was a case of these 4 partners constituting the partnership firm. These all transactions happened in the financial year 1991-92, which was April 1991 to March 1992. Finally, where there was one partner, Mr. N, which was there since inception, and there were 3 new partners who were admitted during the tax year. After these 4, once these 4 partners were running their business, in the subsequent tax year, in 92-93, again 4 new partners were inducted. It may sound a bit confusing, but I am trying to be slow so that we are there on the facts. But the 4 partners were there. If you see on the left hand side of the slide, Mr. N, Q, R, and S, which were the N being the initial partner who was always there with the partnership firm. The 3 partners Q, R, and S, which were admitted in the previous year 91, and the current 4 new partners which were admitted in the year 1992. Mr. T, U, V, and W, for example. Now, when these partners, the 4 partners were admitted in November 1992, they brought in very small amounts of capital, which were somewhere in the range of 2 lakh rupees and 4 lakh rupees. And that is how they got admitted in the partnership. After their admission in the partnership, in that financial year 92-93, they carried on their business. Before the end of year 92-93, in fact, on the very first day of January 1993, what the partnership firm did is that with their 8 partners being there on the partnership firm, they revalued their land and building. Once the revaluation of land and building happened, they enhanced the value of land and building and gave a corresponding credit to the partners' capital account on all the 8 partners. So the valuation amount which was revalued was somewhere in the range of around 17 to 18 crores. And the corresponding amounts were created in the capital accounts of all these 8 partners. The decision is with respect to the 4 new partners which got admitted. So if we were to see this, what actually happened is that the new partners which was admitted in the year 1992, if you see on the left hand side of the slide, Mr. T, U, V, and W, these partners introduced small amounts of capital when they were inducted into the firm in November 1992. However, once the revaluation happened in 1st January 1993, which was just one and a half months post the admission, their capital balance got a huge increment because of the revaluation. It didn't stop at there. What happened essentially is that after that revaluation, 2 of the partners, they withdrew small amounts from their capital balances. And the partners who withdrew their